Welcome to MSO's fourth webinar of 2024, Introduction to Modern Flood Insurance, presented by the dynamic duo of Diana Duke and Evan Forward from New England Excess Exchange. I am Sue Quimby. I am the Senior Vice President and a few other titles for MSO. Thank you very much for joining our webinar today. We're also pleased to have New England Excess Exchange as our newest vendor partner. Attendees will be muted. If you have questions or concerns, please enter them in the chat or the Q&A window. 2 continuing education credits are approved in multiple states for this class. We would like to thank our generous sponsors listed on the website and also on our screen.
All right.
MSO is pleased to offer at least 8 webinars each year. We welcome suggestions for presenters and topics for our webinars. We're hoping to offer CE for more of these. If you missed any previous webinars, they are available for our on-demand viewing on our website, msonet.com. They will be available on our new YouTube channel as well, which is at the Mutual Service Office. Please subscribe to our channel. It's free. This year's Ed Seminar will be held on November 12th and 13th. 2 one-hour sessions will be held each day. Topics are agritourism, claims trends, artificial intelligence, and insuring your online business. These seminars are also free to all. As part of our nationwide school expansion, CE credits will be filed in multiple states upon request. You may have seen our training flyer. MSO offers CE and non-CE training for member companies, agents, and other industry members. In 2024, our goal is to be licensed as a school in 50 states. We are currently at 31. Contact us for more information. I will now turn this over to Evan Forward from New England Excess Exchange, who will introduce the program and the presenter. Evan?
Well, thank you, Sue, and welcome, everybody. Thank you for joining our webinar today. So I am Evan Forward. I lead business development at New England Excess Exchange, and I serve as Vice President of the Vermont Association of Insurance Professionals. I'll be serving as a humble teaching assistant for our presenter, whom I will introduce shortly. First, I just want to thank those who made this course possible. Lindsay Farrar at GW Savage Restoration, thank you for providing photos and supporting flood victims in Vermont. Jeff Price and Union Mutual Insurance Company, thank you for sharing your story and for your service to our communities for the past 150 years. And the International Association of Insurance Professionals, thank you for connecting us with MSO to make this event happen. And special thanks to you, Sue, for your tireless efforts to bring timely educational opportunities like this to agents across the country. So today's webinar focuses on ethical principles in the delivery of flood insurance services. We'll explore private flood programs and NFIP flood programs, but emphasizing our responsibility as agents and advising clients on flood coverage. Our instructor is Diana Duke, who serves as Senior Flood Underwriter at New England Excess Exchange and Auditor on the Vermont Association of Insurance Professionals Board of Directors. Diana's professional journey began as an insurance auditor at PricewaterhouseCoopers, bringing a unique auditing perspective to her flood insurance underwriting. Diana holds an advanced accounting certification from Champlain College, degree in business management from Vermont Technical College, degree in technology and mathematics from Goddard College, and associates in insurance designation from the institutes. In the community, Diana has spoken on flood insurance topics for realtor, landlord, lender, and independent insurance producer audiences, and is an active participant in the annual National Flood Conference. Diana was named Professional Underwriter of the Year by the Vermont Association of Insurance Professionals and Top Wholesale Broker Specialist by Insurance Business America in 2022. Now, with that, I'll hand it over to Diana and plug in my computer. All right, here we go. Let's see here. Can I share? Yeah, there it is. All right.
Can
everybody see those slides?
Yeah, can everybody see the screen?
Yes, I can see it.
Yes.
Right. Thank you, Evan. So hi, I'm Diana Duke. I do flood all day, every day for everyone and any kind, but mostly in the private insurance marketplace. So while that is my core home, in fact, everyone really needs to be knowledgeable in both the standard market or NFIP and private to really embody everything that we need to be providing ethically or otherwise to make sure we're giving the best kind of information. So even though private is my domain, like I'm not saying private is better, NFIP is better, or one is worse or the other, just that there's options. So we're going to kind of go through all of that. All right, master clicker, we plugged in.
Let's see here.
All right.
as we thanked previously some of our contributors and supporters in this project here. And there's Diana, we can provide those.
So a quick run through of the agenda. We're going to go over what flood is, different types of insureds, various flood zones, some different flood risk mitigation ideas, and then we're going to kind of give a comparison between a FEMA flood policy and one of what I call the Cadillac of private flood policies, mostly because they're really broad or they offer a variety of things that you don't typically see with an NFIP policy. And then at the end, which I'm hoping to clock myself appropriately to start around a little after our break at 3, is a case study portion. I'm going to take a look at a residential home that went through a flood, a business, Union Mutual, who Evan mentioned earlier, and then we'll also look at a residential condominium here in Vermont and kind of how things played out for them. Slide, Mr. Evan. So what is flood? Basically, it means surface water built up anywhere where it typically is not. So let's say a parking lot out in wherever you are right now, typically you would hope there would not be water there all the time, or it wouldn't be a parking lot. But when it comes to insurance, it really depends on what your policy says, and it really varies from every policy to policy. So I won't try to read this slide to you, but you can definitely give a look through. But FEMA's definition basically says that at least a general or temporary condition where 2 or more places or at least 2 or more acres of land has been inundated with water or extra water. They also cover overflow of inland or tidal waters, unusual or rapid accumulation of any runoff water from any source, mudslide, and or collapse in subsidence. So the rain causes the ground beneath your porch, home, whatever to displace. That's where they're coming into play. Now, the private market. So this is the legal definition. This is literally from the regulation that allows private flood to offer insurance. In order to fulfill the mortgage requirement, a private policy must provide, among other things, flood coverage that is at least as broad as the NFIP, but most often it has to include more, or it has to be better in some way. So this is how I look at it. There is no one fixed definition of flood in the private insurance. Basically, every form is derived from some sort of a FEMA definition or a FEMA form where they've taken, added, subtracted, or otherwise, but added other things. Or maybe it broadens it or narrows one thing to expand another. So just like any other type of insurance that we all work in or are a part of, like they give, they take, they add, replace, that's the marketplace for private flood. So the different types of insureds, that would be residential. So that's for your homeowners, people renting, or any building with a 1 to 4 unit residential home, a single family rental, a duplex. Now, on the other end of that is the commercial side, where anything that has a commercial exposure to it. So sometimes that's a store below, apartments above. We'd consider that commercial, or a residential building that has more than 4. We'd also consider that commercial. And then the last being residential condos or commercial condo associations. So those are the various types that we see in flood insurance. So what defines a homeowner? Basically, it's their personal primary or secondary home. They live there. What are their kind of exposures? You have your building, you have your personal property, maybe some outbuildings, or of course, the worst of all is the loss of use of your home. Then for a renter, similar but slightly different. They don't own the building or their unit. So for them, their biggest concern is typically their contents, their stock, or their loss of business income, or their loss of being able to use said space. Then you have commercial building owners. Typically a business is operated there. So whether it's a mixed use or otherwise, some kind of business operation occurs. What are their exposures? That building, that business personal property, business income, typically could also still be stock or various other types of things. They'll all fall under a similar head of BPP, but then you also have condo unit owners. This is probably where people have to take extra pause, just like if we were writing a general liability or a property policy. They own just the unit, walls in, whether it's personal or commercial. So what is their exposure? So their contents, the loss of use or the business income or any improvements that they've done kind of to the unit. But the biggest part being they kind of need a second policy. So if you have a condo unit policy, it's covering your walls in. And with that, you also need an association policy to get you those walls out. That's where this comes in. So you kind of need both. If you are a unit owner, you need to have an association policy to make sure you're fully covered all the way around. But an association policy covers walls out for a structure of an entire building. Most often, each unit is responsible for their own stuff, walls in, and their contents. So that means the building, the mechanicals, if they're not in each unit, debris removal, common property and shared locations, playgrounds, laundry rooms, if they're not already in the same unit, those are going to be their biggest exposures. Flood zones. I could probably spend hours and hours on these, but I'll try to keep it limited. So flood zones, we've all heard some of these before. So X, C, and B, what they call low hazard or newly assigned areas or 500-year plains or 100-year plains. Then you have the A zones, so the A's, the A1 through A30s, ARs, AOs, AH, basically any A letter mixed with some other number. Basically, that's a medium hazard, or we know flood has happened there, or there is water there, or we've kind of directed water to be there. Maybe it's a common floodway in a community. And then you have the V zones and the VE, high hazard velocity waves, typically involves the ocean and sending it as its leisure. And then you have no zone. Typically in FEMA or NFIP world, that's basically they're not in a participating community or they've never been mapped for flood risk by the government. So these zones, as I said, they refer to like the 100-year or 500. They're typically going to be further away or on the edge of a real hazard zone, so A's or B's. Most people say that these are the least likely to flood. However, history has shown that these see an equal portion of flood claims annually. These zones just are not required per se by a lender, so they often get overlooked. Then your C zones are emergency zones that are issued by the NFIP. So they're going to be mapped. There will be some future, but right now there's an emergency. So we need to get these people in and get them coverage if it's needed for them. And then I believe the B zones are also currently or have not yet been mapped, but there is like notification that it may need to be. Typically those come up after a significant flood event. So those are where the new communities will start coming in. Every year, new ones are added. Then you have your A zones. So this middle hazard, it is more inland. It's just beyond a VE zone. So if you consider a beach or if you've ever been anywhere along, say, the Maine coast, the beach side would be like the VE side. But when you cross the street, that's when it becomes an A zone. It's a little further away, typically another 20 or 30 feet, so to speak. But these can see or will see more floods than an X zone, so they say. Typically 1 to 3 or 1 to 10 years is a likely spot to see in any of those zones. These are normally around waterways, so rivers, lakes, ponds, dams, brooks, floodways, places where we ask for the water to go, meaning we're saying, I don't want it over here, I want to build a community, we're going to route it over here to this common floodway to get water, out of town. This zone, as they're mapped, have the most prevalent of all floodplains. So we have probably more mapped A letter and number zones than any other zone so far across the United States. And these actually have the most floodplains, which would make sense, right? We have the most of them. So they see some of the most. And then the last one. So high velocity, this is where the ocean decides, we don't decide. These are most often coastal and they do have the ocean sea waves and even bay waves. If you're from an area that has like a good jetty out there to keep things down a little bit. Some of these areas basically always have water or they always receive water directly. So high tide, there might be some water here. Low tide, it's coming back. These typically produce the highest claim values or amounts, but they're not necessarily the highest value of claims or volume, my bad. So typically that's because to build in these zones, you have to either be at a higher height. Like we know water is always there. So in order to build there, you have to kind of combat what you know is coming. So maybe that's 10 foot up where you have to walk up and there's a waterway like right through the bottom. There's what they call wash through bottom. Or maybe they had to build it with steel pipes right through the ground about 30, 40 feet, or what we call pillars or piers. You know water's there. You know water can come. We can't control the ocean. So building here requires you to do that. But that's why it costs so much more money. So from there, flood mitigation. Quick overview of what that means. And we'll talk about levees and dams. We'll talk about raised foundations. We'll talk about floodways, which I've mentioned a few times. And we'll also talk about flood vents. So mitigating your risk, depending on your building and your area and your risk exposure, it really depends on what you can do. So some of the common things we see are levees and dams. Most people have heard about that, like in Louisiana, and I want to say a little bit out in Georgia, maybe, and sometimes even in Florida. Then more people after Sandy in New Jersey talk about raised foundations. Then you have floodways, which is the way we've been trying to mitigate flood risk in communities for at least 55, almost 60 years now, when this program kind of came to fruition to begin with. And then flood vents. Flood vents have changed, I don't know, probably every 3 or 5 years since the National Flood Program came into being. They're more exciting now than they were, say, 40 years ago, but every storm that happens, new companies kind of take a look at things and see where we can do better to help get water out as fast as possible. So if it's coming in, we want it to have a way to get out. Now, community-wise, many communities do pool together their resources to apply like a big mitigation for the whole community. And sometimes that is contingent on your participation in the NFIP program. Others, it's how can we as a community lower everyone's flood risk costs in the most effective and efficient way. So someone up on the mountain isn't going to be as affected as someone next to the river, but as a community, how can we kind of combat that? So levees and dams, typically these are going to occur near oceans or bays, or they'll be in areas that are looking to divert water away, aiming to control water in a certain way or harness it. So some of the issues or potential problems that can occur with these are age, maintenance, impacts over time, and studies kind of informing the build and general construction and kind of play in how effective they are over the long haul. I think back to Katrina, some of the issues that came into play there were that some of the levees and dams did give way. Had they not, would it have been as destructive? We have no real way of knowing that other than it did have destruction. So now when they built back, did they make improvements? Did they maybe add an extra layer of protection or shore something up that maybe gave way in the first place? I mean, that's the nature of trying to combat something that doesn't care. Like water doesn't care. You do what you want and they're going to do it, or it's going to do what it wants. Then the next big one is the raised foundations, moving building higher. So that's not always a guarantee that the water can't do a similar thing, but it sure is a lot easier to say, have water hit your concrete basement or basement wall than it is to hit the side of your home and go through your windows. Now with this though, depending on where you live, there are local rules, ordinances, and regulations that can limit how high you can go. And then there are some that actually tell you how far you must go. So I mentioned Hurricane Sandy in New Jersey. A lot of the homes were raised or in order to stay or be rebuilt, they actually had to go either 10 to 15 feet, cement basement up with full flood vents, just in case the same thing happened. And when I say that, I'm from New Jersey originally. That means 15 feet of just concrete with an open way. So water could go under instead of coming in. And there's no guarantee that that's enough. So at the time of Sandy, I believe it was around 19 feet of water that hit most communities. And that's a pretty penny. The price of this, which I do not mention here per se, depends on your building and your state. It's not always the most effective to like actually do, but the amount of money it can save you if your house didn't actually get flooded, like it's a balance. It's a running game, I guess. Pay now, pay later, right? So one of the things to consider. Now, floodways. In the 70s and right through to probably the mid 90s, a lot of communities created or designed some pathways for water to basically create room for more development or find a way to mitigate water just going willy-nilly and taking everything in its path. And that includes some water drains and stuff that will pull water away from a town or residential area. A designated floodway basically is where we want water to go, so it doesn't impact all the other things that have cost so much to put. And kind of having this central water path is saying, water, I want you to be, tamed now. But as we all know, water doesn't care. It will be a little wild and untamed as it wants to, and depending on the storm. But for many years, this did help. So it's not a perfect solution for everything all the time, but it definitely reduced a lot of the flooding that did occur during that time. Flood vents. So I mentioned these are always getting better. I don't think that I haven't seen any that got worse, but over time they always get better. Basically, a flood vent is installed in the lowest areas of your building or home, not at the floor, but about 3-4 feet up, to allow, if water was to come in, that it could also get out, so long as it's not higher than the vent itself. The point being, they don't want the water to stay trapped. If it's going to come in, they want it to get out. So it is always typically in that lower level. Now, quick comparison here. So NFIP and private flood, they all offer some of the same things. There's some overlap, there's some deviation, there are a lot of similarities, and then there are a lot of differences, right? That's how we love to express things. It's a conundrum, but really they all are playing a big role or a big part in everyone here. That competition, that ability to give us coverage in a catastrophic type coverage it's really important. So we're going to talk about the buildings coverage between them, contents for business or personal. Then we're going to talk about loss of use and business income and how each of them kind of behave or react with that. Then we'll talk about replacement cost, ACV, the differences there and how those come into play when it comes to a claim with either one of these. And then basement coverage. That's probably the most significant difference above all else, is whether they do or they don't cover what is your personal stuff in the basement. What was Trev? So building coverage, NFIP, they offer a max policy limit for buildings, which vary based on the type of building. So residential, I believe it's 250, commercial, I think it's 500, and then condominium, I think they're back up to a per unit price. So per unit, however many units you have, that's going to be your max policy. They typically are looking at one building per policy. I know that at the last flood conference, and we'll probably hear more about it this one coming up, that they are looking to see about getting, your small garage on there or a small other structure. So it would eventually have 2 on it. They don't have any plans to go, 20 million policy or buildings on one. Now, in the private marketplace, our limits over here would be full replacement cost value for basically every type of that. If your house is worth 650 and you want 650 in coverage on your building, we can offer that. If you want 222,000, we can offer that. So if that's your lender's final bill and that's all they need coverage for, there's flexibility in that. Now, different carriers kind of have bucket options, meaning have this or you can have that. So some will say if you want them to match, say, your NFIP limits, they'll say, all right, 250 this, 100K this, and here you go. Or it's the full value of those things. Then there are others who say, what do you want? A la carte. So I want building, I want contents, I want business income. Okay, you tell us what you want, we give you what you want. And then the biggest other part here is most private carriers will schedule multiple buildings and or multiple locations in one policy. So let's say you are a commercial person and you have 10 buildings, maybe not next to each other, but maybe they are. Maybe you want one policy to kind of cover your whole risk in one for flood. That can happen. Contents coverage. Similar to the building coverage, NFIP has a maximum policy limit for your contents, and it is based on your type of building. They do have some limitations on the type of contents that they'll cover. And then there are some limitations on the location of where your contents are for coverage. And big sell, right? They can do contents only. So if you are a renter and all you're worried about is your personal property, you got a policy for that. Now, similar on the private end, full replacement cost on your contents. So if you have, $500,000 basement full of cool stuff, we can do that. Similar with some markets will limit the type of contents that can be covered. To be honest, paper goods in a restaurant is not a good insurance coverage for anyone really. So there may be some limitations to specifics like that in a care or in a private markets policy. And then some markets actually limit the location of contents for coverage, just like the NFIP, meaning if it's above the first floor, they're good. Then there are others who say, I don't care where your stuff is. If you buy the coverage, you've got the coverage wherever it is, except we exclude these few items, or we don't exclude anything. And wherever your stuff is, you buy the coverage, good to go. And then private also can do your contents only. Now, this is where things start to deviate some more. Right now, NFIP does not address loss of use of business income. They do have, I believe it's the ICC, so the increased cost of compliance built in. That is not exactly the same thing. So private market kind of has taken a look at this just like they would for a variety of other types of coverages that we have out in the marketplace. But they'll offer you loss of use on your home. Most often, they'll give you $5,000 for free in your policy. Then others will say, how much do you need? Well, if I was displaced, I need 100K in loss of use. Okay, here you go. You're paying for it, but here it is. And then it's similar with the business income. It's available depending on who you are and what you do. They ask some questions about its annual value, and then you pick up to whatever coverage type you need. This is where we talk about ACV and RCV. So at the time of a claim, whichever one is less, that's what NFIP is going to choose for you. And the private, pretty much most are all on RCV paper, which means replacement cost value. But at the time of a claim, you can pick whichever one is best for you. Then basements. So what is or isn't covered in a basement really varies by your policy form. I encourage everyone always to be looking at the form. NFIP does have limitations on what will be covered in your subgrade basement, which means below grade on all four sides for both your building and your contents. Private market forms similarly vary, and they range from forms that limit coverage to being silent or not being silent. They'll tell you, we exclude these things down there or if it's below. And then there are some forms that actually cover only certain items in your basement, but others who will say, well, all your contents wherever you are. So a quick recap of all of that. So building, NFIP, yes, you can have a limited amount, you have a max off right. Private, up to your full replacement cost value. Contents, yes, limited amount and your max offering. Same with private, still up to your full replacement cost value. Business income, that's a no for NFIP, but that is a yes for private. Loss of use, that's a no for NFIP, may change in the future, but a yes for private. Then you have your RCV, ACV, like I mentioned, for NFIP, it's whichever is less at the time of your loss. And then for private, it's typically going to be RCV, but you do have the option to elect ACV at the time of a claim. And then basement, limited, varies by policy form, but also could be limited or could be a lot broader. So I went fast.
You did. So what we're going to do now is we're going to hop over to what we have 19 at this point different private flood carriers that we work with. There's a lot of carriers coming into this space, and it's constantly evolving. But somehow Diana has forced them all to use our single one-page application, and I think that it's important to just take a look at this because it shows what those key rating factors are. Every carrier has their different things that they're particular about based on the types of coverages that they're offering and so forth. But I'm going to actually just share another screen here, and we can go through that. And then if there are a few questions already, we could potentially address some of those before we move on to the case study here. So
because that's the most fun part.
So let me just escape out of here, and I'm going to stop sharing for a second. Open up this other.
Were there any questions in there? Anybody can see that?
I don't see any yet, but if you have questions, please put them in the chat or the Q&A, and we'll be sure to get to them.
My screen is a little bit small. Screen here to see it. Okay, here it is. There it is. Okay, so let's see. Are you seeing this application here?
You have to reshare your screen.
I have to reshare it. Here we go.
I can see it.
Okay.
Okay.
Yeah, it's there.
Yeah.
I
It's a little small. If you can make it bigger, that'd be good.
I should be able to. It's still a little small. Hang on.
Zoom in, Control plus plus.
Yeah, hang on a second. I'm going to.
Right
Is this it? This is Zoom.
That works too. Yeah.
Oh, this one here.
That's
There you
better.
go. That's
That
our
was-
boy.
Just just roll through this, but I think it's important to look at this just because it really kind of summarizes really the key points to be thinking about when writing.
Can I give a quick run through here?
Yeah,
right.
that would be great.
So even though you can't see it, we're going to compare. If anyone here has already done an NFIP quote, you already know it starts with where are you? They like to do the mapping for you, and you get your format, and it will provide you your community details and all of that. On the private side, all I need is your address, and I can get all of that stuff without having to go through any of that. But otherwise, a lot of the similar questions, I think the biggest difference between their app and our app is I only want to know from you what I actually need to know in order to rate for you what coverages you actually need and want. So I'm going to ask you about, if you know the flood zone, great. If not, obviously we can get that in a variety of ways, but when was your building built? What is the square footage? How many floors is it? What kind of a basement do you have? Are you elevated? Are you over water? Things like that. I'm going to want to know if it's your primary residence or if it's commercial, just like how NFIP would ask similar questions. If you scroll down a little bit, Evan. The other big pieces are like, what is your occupancy? So a single family house could be your home. It could be a home you're renting to someone else. It could be an Airbnb. It could be your second. So depending on how you answer that, may or may not be one or the other, similar for how NFIP kind of asks. And then your values and your limits that you actually want. Now at this stage, if you'd answered all these already with NFIP, you'd probably still have 7 or 8 more pages to go because they do have to ask a few more questions, right? The program is a government program. They need to know more in order to provide you coverage. Now on here though, if you scroll, Evan, after that, after your values and your limits, that's all I need. I'm going to be able to take this and I'm going to go to my carriers, and they all will accept that app, and they're going to take the information that they actually need to rate from this and go out and do it. Even though it's a 1-page app, there's actually a sneaky second page. If you wouldn't mind scrolling down to that second one. A lot of the times people say, I don't know what kind of a basement I have. And it's a good question because, you know, here in Vermont, we have a lot of what we call root cellars, or like half sunken, half crawl space. Like it's not cut and dry. Like on this picture, like number 5, elevated without an enclosure, that's easy. You can walk right through, you can drive a car underneath it, nothing's on the ground. But now one that's half and half, say the 6 one, part of it's a basement, part of it's on piers. Like being able to understand that kind of helps you better understand what's at risk. So before you take off on that, like the first building they have here, 1A, 1B, and 3, there's nothing, there is no subgrade, there is no basement. So water is going to come through that front door and fill. Versus next to it where you have 2A, 2B, and 4, the water is going to go in and it's going to go down to that sunken basement. And when that's full, then it's going to come up through the floors and be willing to get out. And then even less, this lower one here, I believe it's a 7, half and half. So this is similar to like my house. Water may come up through the front door, but go down, but have an exit plan in the bottom there. So the water can still get out. But knowing the difference in kind of basement you have really does play a role in at least private for sure. And more so now in NFIP as well.
We do have a couple questions.
I love questions. These
You
are
want them now? Okay. All right.
Let's
What
go.
percentage of flood policies are written in the private market?
Ooh, that's a loaded question. So here's the thing. NFIP has to tell us. It's a government program. There's legalese that requires us to. So the private market does not. They do annually, at least once every year at the flood conferences that I go to is when they kind of come out. My best estimate is, that's so hard. You want a real number. Last year at the flood conference, I believe they said it was about 35%. So the private market had expanded in 5 years, 35%. So what that equates to in policies, I'm not 100% sure, but we're coming. Like it's starting to level out. So right now the flood landscape is like 76, 77 NFIP and like 22 out here. But how factual that is, there's no real way to know unless we make the private flood markets, give us public information that they don't have to. It's proprietary for them. But we're coming. There's a leveling balance. And you really need both, right? Like you can't have one without the other. You need both. Competition wise, coverage wise, not everyone fits in the buckets that are available with the NFIP. So you still need it. So ultimately, anyone that's in a non-participating community must have a private policy if they wanted flood coverage, because you can't get it here. So you kind of need both. I don't know if that answers it very well, but it's as honest as I can
Get
be.
to the bottom of it at the National Flood Conference.
I'll get you some answers.
Or whoever goes to the IP National Convention, I have an answer.
Got another one?
Yes. Are there insureds or properties that cannot be covered by NFIP or private insurers for flood risk?
So I think it depends. So NFIP has to take anyone in a participating community, but they do have some more stringent rules now about if they have a lot of prior flood losses. It used to be in their program called the repetitive loss program. So basically they took you out of this regular one and put you in this one, meaning they know you're going to continue to have losses, so they just charge you more. Now in the private market, because they have the ability to select a risk, they're not required to take anyone. I mean, there's definitely a chance that it could be a decline. One of the things that I think I get the most declines on, which maybe is weird, but lighthouses. So a lighthouse on a hill or a bank, say, or on a bluff in Maine, no problem. A lighthouse on a bunch of rocks in the middle of, say, a bay, not so much, right? It is a building, it does need coverage, but it's technically already flooded. So the definition of the flood policy means it's always flooded and there's no way for coverage to kind of kick in, right? Because at the beginning, like I mentioned, definition is that a place that is not normally covered in water becomes inundated with water. So you couldn't do that because it always has water.
A couple other questions. Why does private flood coverage not satisfy NFIP requirement for prior flood coverage?
Ooh, I think I'm gonna need clarity there because that's not true. That's not true. Every policy, we don't have an example of mine, but all the regulatory things on the books, there's two big ones that allow private market to offer flood. We were recently, I think it was just last year or a year and a half now, that even federally backed loans have to accept private market flood policies as long as they have these two regulations kind of stamped on there. Now, no private market flood can exist or be allowed to offer coverage if it doesn't give you at least what NFIP does. So they couldn't exist. That's not a thing.
Be able to be eligible to provide the coverage needed for a federal.
Right. You can't
And you can't really participate in the market if you're not providing a coverage that satisfies that.
Yep.
Really.
If you don't meet that regulation, they kick you right on out of there.
We have another question asking for a definition of participating towns.
Ooh, so this is a government piece of information. It is public knowledge. If you went to you can Google it just like this, FEMA participating communities map. They do it by state. They do it by all of the states. So on my desktop, every 3 months, I pull a new one. And I use it every day at work here, because we have to check. Now, just because you've joined a participating community doesn't mean that you're still in it. So if your community doesn't do what they require you to do to participate, you can get kicked out. You can also be limited, and it happens more frequently after events when something maybe should have been in place but wasn't. So you can get that. So I would literally Google FEMA participating communities, and you'll be able to pull a whole PDF spreadsheet with, I think the most recent one has 996 pages, but it is searchable by state.
include that in some follow-up.
I could definitely,
Yeah.
well, it's a big attachment.
That's a big attachment.
It takes a few minutes to download, but we could,
We
maybe
can
we'll
link.
put a link instead of trying to attach a PDF like that after the fact. I'll get you a link. And you have to look frequently, know when you pull it, know that they update every 3 months, at least. So somebody in a participating community today, again, if something went wrong or they didn't do their thing, they could be out 3 months from now. It happens all the time.
Another question, what about properties in a CBRA?
I call them Cobra zones. So NFIP has some special rules, right? They're saying that this is coastal barrier reef island type areas. You know you shouldn't build there because nothing survives. Now, the private market, some don't want any part of it. Others are like, we know what's going on. We have been a part of this community a long time. We right there. So you can still get policies in Cobra zones in the private market, but rightfully so, as a taxpayer, I am proud of NFIP for not making us take on that kind of a burden for Cobra zones. But private markets, I think they can afford it for the most part, and it's not my taxes. Tiny slice.
For private flood, are there elevation certificate guidelines or does that follow NFIP requirements?
Oh, good question. So I hate being this devil's advocate here, but NFIP actually did away with elevation certificates a few years back. If you have them and they say good things, they can help you. Not with NFIP, but they can help you in the private market. If you have one and it doesn't help you, meaning it's showing that you're severely negatively elevated or more exposed, then it wouldn't help. How I take that in is if someone sends me a submission and I look at it and they send me one, I'm going to say, here's what this says, and this is what this means. Do you want me to include this with my submission or not? And I say that because an elevation certificate is only as good as the moment you did it. As soon as that night or day turned to night, nothing is the same. Every time it rains, the topography of our whole world changes. Slight, but over, say, 6 months, where you might have been 3 feet elevated, you might be down to 2.5 now because of settling or the rain or just stuff moving. So they can help. They're not required though. No one requires them anymore because NFIP stopped requiring it. So did everyone. We got to keep in suit. But if you have them and they're good, it's worth it. They do cost money though. And depending on where you live, it's a small, I don't know, a small car payment or 4 car payments, depending how much, it depends on your area. So like here in Vermont to do one, just like in my community, is about $2,000. And like I said, it's only as good as until it rains again, really. So it's helpful if you have it, but they do like lose their efficacy over time. So if you had one from 1986, I'm not going to be able to use that because I know it's not right. And I know things have changed since then, no matter where you live, doesn't matter.
So that means that if for NFIP, the rating is no longer based on the degree of elevation?
So not that. It's that an elevation certificate was required for anything post-firm. So they would force you basically to go get it. You built, since we knew this community was a flood zone, you had to have built it this certain way. They took away that requirement and now they just ask you the questions.
You explain.
I have
Oh, so maybe I should. Firm. The difference between pre-firm, post-firm. So basically in 1974, when the government made the NFIP program, everything built before that was not flood rated or flood tested. So it wasn't built up to some flood code. So we call that all pre-firm, meaning they built it before we put any regulation in place. But anything built after that, or built in a community that was participating later on, like they're called post-firm, meaning we've now had regulation in place. And when you built, you should have flood guarded with these rules based on your community. So where I live in Williamstown, it's after 1986. If you wanted to build on or near a river, you couldn't have a subgrade basement anymore, which seems smart and great, considering how much flood damage we had gotten in this past storm. But so not required elevation certificate. That pre-firm, post-firm makes a difference. Most everyone post-firm from 1974 to 2021 was required to get an elevation certificate to build. But now, because it's not required, no one has to do it. But if you do it, has benefits, has drawbacks. I don't know if I answered that correctly or not. If not, shoot me another question. It's kind of like three things in there.
We have one more question right now is I wanted to move private flood policy to NFIP policy with write your own company. I was told a private flood policy did not qualify for rollover for 30-day waiting period. I'm trying to move this down. Waiting period would still apply to NFIP policy. Why?
Because that's the government for you. So that is true. So if you want to move from private back to NFIP, which you can do, you just have to be aware that they're going to do that 30-day wait for you. So you need to order it down, basically order that NFIP down 30 days before your expiration of your private. And it's kind of the same in reverse, except for if you want to go from NFIP to a private, most all don't have a waiting period. And most all would waive one anyway if you had prior coverage wherever it was from. So if we don't want that waiting period, that is where you would be talking to your senators and your representatives and saying, hey, this program is supposed to help us. Even though it's meant to be supporting a catastrophic program, it's not attainable or not reachable to us. So that's where you would start with that. But if you want to get what you want there is going from private back to NFIP, which does happen. Let's say it was a 6/1 date you needed it to renew. You just have to make sure you've ordered it down with NFIP by May 1st.
And we have another note saying FIRM means flood insurance rate map. And Michelle put a link in the Q&A for the community status book.
Thank you.
Thank you.
And I think that's all the questions I see
Do you want to
right
take
now.
that?
So
You want
we're
to
ready
take
for our
that break?
10-minute break. Yes, we'll be back at 3 then. Eastern
Thank you,
time.
everyone.
Welcome back, everyone. Diana, take it away.
All right, so this is my favorite part, not because it's, you know, sunshine, roses, and it's a beautiful thing. This is actually catastrophe, right? People's lives were severely disrupted, businesses were disrupted, as communities were destroyed. But the fun part for me, or what makes it exciting for me, is you don't know how your policy is going to pay until a claim comes. Anyone who's ever had any type of a claim knows claims adjusters don't like to talk about hypothetical claim, and they definitely don't often like to share the results of a claim, like however it played out, whether 10 people had to weigh in or they declined or denied this but gave this. Like, it's a complicated situation. So one of the important parts for this class, I felt, was that we really get in there and look. So this is from the lens of the best that NFIP can offer and the best that I could find in the private market to offer. So these are real things. These are real people, real businesses, real places here in Vermont. And some of this might make you sad, might make you think a different way, but that's the point. Nothing about this is meant to be sunshine and roses, because it's not. So I'm gonna let you go ahead and talk about in the beginning. But first, here we go. This is what happened.
All right, so we basically, wasn't a named storm. We had a big flood event, Hurricane Irene, that we had a substantial flooding about a little over 10 years ago. But this past summer, it was just a lot of rain.
Just rain. It doesn't get a name. It's just rain.
And it had been raining a lot in the month previous, leading up, the days leading up to, the weeks leading up to this time, and the ground was just saturated. And I wish this loop would go.
Well, the loop won't play for you.
I thought I had it as a gift that would do that, but basically they had to make a whole new color category to show the amount of rain we got just in this 24-hour period. We got, basically some of these areas seven
plus, which is all that
plus
real
inches. And this, we're right in the center, like right in the middle of this purple, like the darkest purple in the center of the state is where New England Access Exchange is
right here.
Our headquarters. So it's hit pretty close to home, quite literally. So what happened was, on July 9th, we declared a state of emergency after basically getting flash flooding in the Burlington coverage zone, which was for the first time ever. So the subsequent days, we witnessed widespread flooding road closures, washouts and mudslides, and numerous water rescues with significant damage surpassing that of Irene in 2011 throughout the state, like I mentioned. Now, while Vermont is not immune to or without its own flood history, the severity and frequency of these large events should give pause to all non-coastal states. I mean, Vermont doesn't have any.
We're
ocean.
mountainous.
We're
We have
mountainous.
mountains. Mountain this side, mountain this side. So sure, we have a valley, but that's only if Canada wanted to release a river on us.
Exactly. So with that setting, we get into our case study, which is going to explore some of the lessons from our experience here in Vermont this past summer. And it explores, as I said, flood insurance considerations, coverage considerations through both the lenses of NFIP and the private flood insurance marketplace. And one thing we maybe haven't touched on as much is it's not always one or the other. Sometimes the best solution for people would be an underlying NFIP policy with a private flood policy
Excess.
providing that excess or maybe that contents coverage.
Excess, so it would be excess over, but yeah.
And so we're going to look at the main types of insureds that we discussed earlier, the residential insured, a commercial building owner, and a condominium complex in the case study. And for each of these structure, each of these cases, we're going to be looking at coverages available through NFIP and through the private flood marketplace before and after. So you can kind of see generally in these cases, what kind of premiums and what kind of coverages were available based on the location and the characteristics of the different sites. So we have photos that we're going to share of these different case examples.
Basically each claim. We have some
Each claim.
plenty of photos for you to kind of look at here and get an understanding of what happened and how it went.
And it will provide a kind of an honest look at what happened, and these are all every case is a little bit different, and every situation is a little bit different. But hopefully this provides a lens just to see how to think about these situations and think about flood risk for your clients. And again, this is an ethics class, and that's sort of the responsibility. It's a huge responsibility that's placed on us agents,
Everyone.
general agents, retail agents, everybody involved, to try to really provide our clients the best advice
And the most information.
Most
like-
information.
NFIP is not the only rodeo in town. They haven't been, even when NFIP came around, private flood has always existed. I just think in the last, say, 15, 20 years, they're like coming more into their own. They knew there was some issues over here. There was openings and things that there were gaps basically in NFIP. They don't cover everyone. They aim to cover as many as possible, but there were gaps. So the private market kind of had to step in and say, you need someone providing this type of coverage.
And particularly once FHA approved it for a third of that
Yep.
mortgages, it really kind of has come into the mainstream. And
Everyone's on the same playing field now.
Yeah.
Love it.
So let's dive in.
All right, let's do it.
So the first one.
So first, we're going to talk about, I'm just basically going to give you the same kind of details. A lot of the same information is what we kind of showed you I would need, say, on the application to kind of go out and get some coverage. So single family home, 1965, it's a pre-firm, Williamstown, Vermont, community down the hill, like I said, about $265K for a building value and $135K for a contents value. This is in an X zone. It's 30 feet above the waterway, meaning there's 30 feet from the top of that waterway to where the home is. Then the lowest level is 3 sides underground walkout. It's not considered a basement for private, but in this case was considered a basement for NFIP because parts of the building on the 4th side were partially under, but there was an opening for like doors to escape. So semantics, or that's the little form read, right? Like that's where the forms come into play. All the mechanicals were in that lowest level and it was fully finished.
So at X zone, we consider that to be a low.
That's what they call
zone.
low hazard, or 1 in
Okay.
500 or 1 in 100. That's what they say. So pre-flood, what would the policy look like? So as I said at the beginning of this, my goal is to say, what is the best at NFIP and what's the best I can find in the marketplace? So it's not a preset sale. It's, I took our app, I go and look and say, what do we got going on? So NFIP's max offering was 250K on the building, 100K in contents, lowest deductible 1,000. Pricing wise is about 1,800 plus taxes and fees. Private market, 265K in building coverage, so went up to that full RCD, 135K in contents, again, up to that full replacement cost value, $1,000 deductible, 2,200 taxes and fee. So $400 difference for about 50,000 more in coverage between the building and the contents. Not a bad sale, all right? So what happened? 10 feet of water made it into that lowest level, and it stayed for 3 days. All the mechanicals were submerged, all the content submerged. Trees that kind of came down this waterway actually pierced the side of the home, that were partially through the wall. Fuel, wastewater, muck, debris, everything that you can imagine from outside is now kind of inside. What had happened was about a mile or two around the bend, the community floodway became overwhelmed and it failed. So basically it overflowed and came through the community at the best way that it could. Also in that same water path, a mobile home and a car travel trailer basically were pushed into the riverway, and they blocked the water from its path that we had designed, basically changing its direction and having it go directly into the house. So debris removal, that's the first thing. Once you got to get everything out. So at the time of a claim, your obligation is to kind of take information and data and details to provide to your insurance carrier. So first, you make it as safe as possible. So they say, get it out. So this is all the out. Everything's out. Then what actually happened? So this is now that pile of outside has been documented. People have taken their photos and lists have been made to say what's in or out. And this photo here is kind of the stage of everything's pulled. We've got the walls down. We've got the dirt peeled out. You can see there's no exterior. So what were the damages? Plumbing wise, about a little more than 9,500. Heating wise, pretty close to 16,000. Electrical, about 8,000. There's a fuel tank in there. You know, here in Vermont, you got to keep that stuff warm in the winter. So that was inside of the basement, about 2,400. All the personal contents and other things in there, about 31,000. That giant pile, right? The exterior wall, about 12,000. Insulation for the inside, because again, it's Vermont, you have to have that, about 2,200. Materials and various things. So screws, basically everything that these people had was in there. So they needed new hammers and nails and all of that. So that all ended up being around 7,100. And then to clean up, by clean up, I mean spraying with bleach and various other things to get rid of the, human waste that was in there, the fuel, and being able to kind of clean out the inside. And then you have that debris removal. That was about 6 tons, that pile you saw there in the last picture. So all in, about $101,000 worth of damage. Breaking that down, about 57,000 was for the building, 31,000 in contents, and debris and cleanup is about almost 13. So how did that policy pay, or would that have paid if it was that one was selected? So the NFIP payout, 26.2 for the building, 18.9 for the contents. Total payout, $45,100. There were limitations on the building and the contents reduced because of the form. Now, private market, similarly, their payout on the building, 56.2, 30,000 in contents. They paid the full debris. So their total payout, 98,990. So the difference being the deductible. That's it. Now after the flood. So you've done all that. Everything's great. You got to get the policy again though, because now you have flooded. So now everyone's going to require that you get a flood policy. How does that look? So typically with NFIP, after an emergency situation like we had here, it can take 6 months to a year for them to update their rating in your neighborhood. But typically when it does, you're going to pay now for having had a loss because you probably may have another one. So NFIP's new policy after having that flood loss, 250K on the building, 100K in contents, $1,000 deductible, now is about $6,800. Now, private market, same thing. Going with those same max coverages, again, it's about $8,500. So there's some difference, right? It went from $1,822 to like $6,000 more amongst them. And why is that? if you flooded once, you're very likely to flood again because water found its way to you that one time, unless there's some severe, amazing, creative thing that fell out of the sky and blocked the river. So they can remove that and it shouldn't happen again. Well, I can tell you, thinking about a mobile home blocking the river and a car trailer rolling down said river to hit this thing, to block this thing, you can't underwrite for that. And as an insurance agent, you can't necessarily plan for that. But those are the things that come up. And that's why people don't love talking about claims, right? So next slide, Mr. Edit. So let's give a little chit chat. So first I want to say, that's actually my house. That is what happened to us and my family last summer. And as someone who sells flood insurance, and I read these forms and I know these forms, and I feel confident in what we know, you can't underwrite for any of the things that had to happen for any of that to happen to our house. But we've learned a lesson, we know different things, and we're behaving in an appropriate way. So when I say that anything can happen to you and it doesn't matter your zone, I really mean that. And not because I sell flood insurance, but because I've lived it with my family in Sandy, having this happen now. Insanity, you don't know until it happens to you. So let's give a little chat. So the coverage limitations here, every flood policy is going to limit things. They can limit payments for buildings, contents, pre-existing damage. They could even say, was this a flood? Now, the biggest hurdle we had here is my neighbors on both sides, their house is higher and they don't have a walkout basement. So only I was affected for more than 2+ miles. So my policy maybe wouldn't have paid at all in some instances, but based on what we've got in for data right now, I would have gotten at least a portion over here and possibly the best that you can get for the other, but maybe not. That's the sad part. But the loss drivers here, it's all of your contents, everything you have in your basement, the debris clearing, access to get in to remove and repair. Water was there for 3 days. We could not get in. The water was pouring in from, like, fresh water was also pouring in because all the pipes and the water heater got thrown around and so much damage had gone in. And we literally had to wait for water to go. But the water had nowhere to go. That's why it was still so high at our house. It came fast as a wall of water. And then everything just kept clogging the way, basically, all the way through town. Not just our house, but the further we went down. Now, the biggest piece here is when something like this happens, we're all fighting for the same resources. How do you get someone to come out and help? So we fixed a lot of it ourselves, mostly because we couldn't get people to come. Like, they were busy. Big businesses who could pay right now, right then, kind of got the best of it. We had just finished that area. I believe my furnace was about $7,000 like 6 months before, but after it was almost $15,000 because we all needed them and there was so few of them. So that's one of the things to consider here. People say all the time, it can't happen to me. My lender doesn't require, I'm in an X zone. No way water could ever come to my house. My house is 30 feet above. That took 40 feet to get to me. And we're in Vermont. It was rain. It's not a real storm, but it was a storm, but it was just rain. So something to consider. If that can happen here, we know it's already happening other places, but total surprise, shock.
We have a comment here. Somebody said they have a commercial client who took a pretty big hit last July in central Vermont. No kidding. They had $150K in flood and were pleased with the handling of the claim. They ramped the coverage up an additional $100,000 and pleasantly pleased with the relatively low impact on premium. Flood should be a part of all conversations. Exactly.
100%. Somebody put that on a t-shirt and you're going to sell it because that's the fact. We have to get rid of that old mentality. When flood came about, it's, oh, it can't happen to me. Well, since 1974, it's happened to millions and millions and millions of us. Just here in the United States, but we could go global. It's happening everywhere. And to some of those people, it's happened 5 to 10 times already in that same amount of time. So it should be in every conversation. If you have personal property that you care about, be it a building or your stuff, if it rains at your house can flood. I don't care where you are. Top of the mountain, bottom of the mountain, it can all happen to you. Because if you're at the top and flooding comes, if you're the subsidence or where everything collapses, that could still be you. You know, same policy answers for that same stuff. All right, we've talked about it. Are we ready for another one? So that was residential. Now, Evan at the top of this, thanked Vermont Mutual, Union Mutual. Ooh, that was,
But
they're also a mutual.
They're both in Montpelier, both got hit.
Both got hit. But sorry, Union Mutual was kind enough to like give us a look-see inside their loss. As I mentioned also, most people don't want to talk about it. It's nobody's real business. Normally they keep pretty tight-lipped, but they pulled back the curtain for us and were able to kind of give us a good lens into what's happening on the commercial front. So here's the details. It's a commercial building, 1952. I feel like it's actually a little older than that because it's kind of a two-part structure, but we'll go with 1952. It's a pre-firm building in Montpelier. It too is in an X zone. It's across the street from the Hudson River. Winooski. Across the street from the Winooski River, plus many roads, buildings, or whatever before you get to it. It had a finished basement with an elevator. It has flooded in the past, and they have done a lot of mitigations. So they used an emergency response kind of prep program many years now, because Montpelier has definitely flooded a few times in the last 30 years. So what they did to kind of mitigate for themselves. No servers are in the basement. They do all cloud-based IT. Basically, when anything happens, the business can continue as long as their remote workers have power at their own home. They were able to shut down power at the onset of the storm. So when the governor on July 9th announced the emergency, because we knew what was coming, like they were able to turn the power down before anything really happened. They were able to raise the elevator above like the flood level of expected flood level. Pre-flood, they were able to move other things up. So that's materials they might keep down there. I think they said they had a few printers and whatnot. But all things like that, they were able to move up, tables, chairs, anything that they could potentially save. They had also been outfitted with like shut-off valves for the sewer lines so that they could separate themselves from the city. So when the city is inundated, everyone connected gets the same push. So by having that put in, it kind of kept them, they were able to keep that out and also keep themselves kind of separate. They diverted their own rainwater into a different way instead of going into the city, which was already being overwhelmed. So their real only fight on this day was when the Winooski, how far it went, so how high it would come. So that's the skinny that they would tell us right up front. So imagine their policy, and these values are asterisk because they won't tell me the full truth, but they gave me an estimate and I will trust in them for that. So an NFIP best possible policy, 500K on the building, 250K in contents, $1,000 deductible, 13,500 plus taxes and fees. Private marketplace, 4.2 million on the building, 1.25 million in contents, 100K in business income, 10K deductible because of their basement / elevator. About price tag, about 36,000, almost 37,000 plus taxes and fees. So what happened here? I know that kind of looks like it's going down the stairs to maybe a brown step, but actually there's like 7 steps missing there. So you'd have to go down a significant amount. That's how much water was there. So water from the Winooski basically came over the roadway and entered their building and flooded their basement. Their internal pumps were overwhelmed. Water filled the whole area and it flooded all their stairways. The interior walls and carpets and equipment were lost that couldn't have been moved before. The muck, the contaminated water, the debris, it all remained until the water actually kind of left or was helped, to get out because it couldn't all leave on its own. It's easy to get in, hard to get out.
And this photo is provided by a GW Savage, who's just on the ground as soon as flood happened, just trying to help people. So that I really appreciate what they did for the state and for this presentation here.
So damages. So biggest damage for them is that initial mitigation. So you got the debris removal, the water removal, the dry out to get it better. So estimating for them, it was about 175,000. And what that meant was when GW Savage came in, they sucked out water, they put in lots of drying pumps and hoses and basically removed as much debris as possible and saved whatever they could. Then they had to replace the interior drywall, the flooring, the electrical, the plumbing, the painting, the HVAC controls and equipment, the generator transfer switches, the office furniture, and the supplies that couldn't be removed. That was another 120K. Then their biggest part was they need to think of what more can they mitigate to try to reduce any of these costs. So one of the things that came out was they needed to move their baseboard heaters basically from the floor up to the ceiling in the hopes that it doesn't fill the whole ceiling. But if they had had mounted versions, then when the water came in, it wouldn't have basically impacted those. And then the other part was they felt that their biggest exposure, their water entry point, was actually a basement egress. So they plan to install an actual panel for that will make it watertight. So maybe water wouldn't have been able to come in the way that it did. But to make that additional mitigation, they estimated about $85,000 to $100,000 just to move heating from here to here.
And 3 years of flood insurance premiums.
Plus 3 years of flood insurance premium.
Oh, boy.
Or equal, right? So then this is some more. So this is them basically drying out the area, and they did a great job of sucking things out. After a flood, the things that most people are worried about are, mold, what was in that water and how is it going to impact people after drying. And GW Savage does a really great job when it comes to the restoration. They make it right and tight at the end. Like you would never have known that it happened. So.
Got a comment here. We had 24 commercial claims in Montpelier, all with NFIP. The only claim not paid was the one for a location where they missed the premium and coverage lapsed. Remind your clients that if the coverage lapses, they're stuck with the 30-day wait. And that came from Peter. So, yeah.
And another bonus thing in there is pretty much all flood policies, private or even the NFIP. If you don't make that payment in the certain number of days at the time of a claim, if you haven't paid your policy, there is no coverage. The payment is the requirement that finishes that contract to make a policy pay you. It's typically right in the first few pages. It's like right up front. We will pay if these 3 things are met. You've paid your premium, you provide the information we request, and or you allow us time to investigate your claim, whatever. So that's very smart, very smart. So ultimately, if Union Mutual had gotten a NFIP policy or a private market policy of the like that we described, this is kind of how it would have paid out based on what we know and the information they provided about the loss. So for NFIP policy, they would have gotten $36,000 towards the building, $500 towards the contents. So a total payout of $36,500 compared to, a little over $550,000 in damage. This is because most everything was in the basement. And it's going to be limited to basically the mechanicals of the structure. So the heating part they would replace it, not necessarily help them move it up, but they would help replace what that would have been covered under it. Now on the private policy, 170K on the building, 10K in contents, 25K in business income, the full 175 in debris clearing and cleanup. Total payout would have been about 380. While they did not have a limitation on the basement part and the things related, there were certain items that are specifically excluded. So that included the elevator mechanicals and unique equipment attached after. So they had a special generator down there that wasn't officially connected to the building. So it would not have been like it was there and it would operate. You flip a switch and plug in a thing, it would do its job. But because it wasn't physically and actually connected to the building, that would be a no-go for that specific policy. So now after the fact, now you've had that loss, and even though it didn't pay that much, the price tag is a lot different. So same max policy for NFIP, now $74,000 in price now. And then that private market, again, same coverages, but closer to 200K. Why? Well, you have this claim. You're very likely to do it again. If you switch, we can do the talk about it at the same time. Like the price tag goes on, it's happened. It's happened to you before. In this case, they already knew that they would always be continuously fighting potential flood. They had been dealing with before. They took on basically. They didn't want a policy because they're basically self-insuring. They're saying, I don't want to run the risk of my policy may not pay. So I'm just going to pay at the time of the loss. And they did, and they do, and they've built in mitigations and they've handled it. And that is great. If you as a company can hand out, a $500,000 check to get it cleaned up real quick. Me as a homeowner, I do not do that well. I'm sorry to say. I do not have, say, 200K to please make it right. I'll wait over here at this fancy hotel and I can afford that too. Like, that's great in the sense of the business. But they knew that going in. They did a lot of that ERP planning of saying, how can we protect as much as we can while still staying here because we love our community? It's like, that's the other piece of it. When you have a loss like this, people get out. The places I lived, like so my family being parts of New Jersey, a lot of people left because you had to do this work. But we don't want to lose our community because we can't, or we're not prepared, right, to have this type of coverage and or know that this risk exists to us. So let's talk about it. The finished basements, depending on the form you have, there's going to be limitations for what will or won't be covered. You should read all of them. If someone says, here's a really great quote, I think you'll like it, ask for the form. I know I hand them out every time when someone says, oh, I've never seen this one. Here you go, take a look. You want to chat? I talk to people on the phone all the time because it doesn't matter what I say or what their pamphlets say. It matters what their forms say. And then of course, it's going to matter what the person who's handling your claim interprets those forms to me and how they play into your claim. So as an agent or the steward of saying to the insured, I want you to know that this policy does cover basements and this is what they don't cover in your basement, or this policy doesn't have basement coverage and that means only this is covered. Like it's really, I behoove you all to make sure you're reading and looking at those forms and gaining a good understanding yourself so you can kind of pass that on. I heard Peter say that a lot of the ones in Montpelier were paid. A lot of the ones in Barry were not, NFIP wise, because of those basements, and it was mostly basements that impacted Barry. Granted, the water was not as high in Barry as they thought to in Montpelier, but a lot were not. And that's private, that was FEMA, and otherwise a lot were not covered, unfortunately, because it was mostly contained into that basement. So there was a lot of issues with that. The other piece here, your building structure details, basically, they cover it in the form. So if my policy is, say, an NFIP, it tells you what it means to be a subgrade basement and what they aren't going to cover. It tells you what it means to be a non-subgrade and what they will cover there. Make sure you're reading those details. Similar with your contents coverage. You want to look in the details. So an NFIP policy in your basement will cover a washer, a dryer, sometimes an air conditioning unit, normally a freezer, like it's specific. Anything that's below subgrade, this is all we're covering. It's important that you look for that both in a private policy and an NFIP policy, but being aware. So if your insured says, oh, my laundry's down there, is it just your washer and dryer? Is it something else? Like knowing that information is going to tell you which best form is going to cover what they need. If they don't have a basement, then again, the form is going to help you understand this works for you or it doesn't. But we can't just say anymore, I have NFIP only, because you don't. There is more choices out there. Now, the lost drivers here for this giant commercial building, which is a staple here in Montpelier, is the repairs, the mechanical costs, the debris removal, the cleanup and the access, the mitigations that they're doing, fighting over the same resources. And basically they saved themselves more money by their ERP pre-planning. They had an inventory of everything, where it was, what they could move, what they couldn't, what it took to move, having that wherewithal and foresight to turn off the power, to turn off the generator. Like the repair of the generator is cheaper than buying a new one, right? So their thoughts and their stance was, we're self-insuring and we're going to mitigate as best we can with what we've got.
As an insurance company that has a regular own
And they are an
program,
insurance company.
they have that competency, but it's a lot to expect of.
100%. All right, so the last, do you have any questions out there, Sue, before I jump into this last one?
Don't see anybody right now, so keep going.
Okay. This one typically gets a few questions, so please lay it on. So a residential condo association, here's the details. This was a 3-story, 3-unit condo built in 1985. So this was a post firm. In Vermont at that time, we were not required to have an elevation certificate. So that didn't exist here, but it was here in Bennington, Vermont. Full replacement cost value is about $775,000 on the building only, because this is an association, walls out. It is in an AE zone. It was right near a river, very nice river. Had a basement. All 4 sides were below grade. All the mechanicals were in the lowest level for all units. So in this basement was everyone's heater, everyone's water heater, the laundry, everything that you might expect in a unit was actually in their basement, and that's how this condo association was set up. So options for your policy, NFIP, $250 for your building. You could either do at that time, I believe it was 75, or it was either 50 or up to 75 you could do per unit, but their max, $250 for the building, $1,000 deductible, $700, walls out, nice cheap price. Private market, the full value, $775K on the building, $1,000 deductible, $1,900. So big difference in coverage, slight difference in premium. So what happened? So basically, this river expanded beyond its banks.
We had a question, there's a question on that, Diana. Host firm, but no elevation certificate required when built?
Correct, because in Vermont, the community hadn't finished their participation just yet. They're in 1984 and a half. So I think it was finished in 1986 was their real firm date. So basically what happened here, the river basically blew out its banks. It destabilized everything. Basically the whole area collapsed. This was a total loss. The entire building was swallowed into the river. There's nothing left, except for what you kind of saw here. This eventually tipped the rest of the way. So how did that pay out? NFIP, total payout $249,000, which is your building amount minus your $1,000 deductible. Private policy, same, $774,000 payout, $1,000 deductible. What happens now? So for NFIP after this one, nothing until you've rebuilt it. If you can build it there, it'll be based on that new structure detail and any flood mitigations you did. Will you have to probably pay some extra premium somewhere to someone? Probably. You had a total loss. Same in the private marketplace. There's nothing that you can do until it's actually rebuilt, if you can. And based on that, it's based on what your new structure is, how you built it, and whether you did any flood mitigations in it as well. So coverage limitations. In this case, it was a total loss. So a couple things. Total loss is easy. Sure, they were able to show proof of picture of it basically being swallowed by the river. They were able to do that. What if you couldn't? First, you'd have to just prove that your building actually existed there, that it was actually on a foundation. Like, these are actually some of the more complicated. Yes, every claim is complicated, but these are more complicated. So a house that isn't near a river that everyone can see and take a picture of basically means, did your structure exist? The investigation they're going to have to do to try to find value and compensation for the things that were lost that you can't see. So if you remember in the first example, you can see that giant pile of debris. You saw it all out there. For this one, once that did the final tipping, you couldn't see that there was a bed in there or that there was anything in the basement, whatever was kind of left, because it basically was sucked back into the river. So what that means is you can't predict what will happen next in this location, but it means the cost drivers of what you have to do next and the costs associated with will be different. So for this one, it's a total reconstruction. Things that cost $775K 30 years ago do not cost that now. The price tag is a lot different. So much like my furnace 6 months difference, where it was like double, I imagine the cost to reconstruct this same building would be like 2.25 million now. Just building is similar, like in kind, just on the costs. And if you were trying to do it right after the event, we're all fighting for the same resources. And after an active event, whoever can pay first typically gets that first. And that means for the materials and equipment to do it, the labor force, the actual things you need to do it, the permits, the town ordinances. Now that you're building again post-firm, are there current flood rules in place that didn't apply the last time you built it? Like, there's so many more things that kind of go into this one. All right, so
before we hop into that though, I just want to so you say you have this a condo owner is your client.
Mm-hmm. So a unit versus a unit in, say, that condo. A
unit in that condo. What should you advise them as far as, it seems like that they're to a certain extent vulnerable to what the associations and what they agree, like, I guess the bylaws
that's require. Pretty much how it is.
So how does
So condos, much like in the regular marketplace, let's say you if you were a unit person, you may or may not own the entire structure that others own into with you, right? So it just depends on how your ownership is. But let's say for this one I used in this example, it's a 3-unit. Those 3 people are part of the condo association. In order to have full or complete risk coverage, you need the 2 policies, the association to get the walls out. Now, we didn't talk about what the unit people in there would be, but part of flood policies say actually, in order for your contents to be coverage, it has to have been maintained and stayed inside the structure during the event, right? Except for in a situation like this. As long as the structure can be proved to be lost, like I said, you can see in the picture, you can see the stuff falling out. So their policy likely would have paid as a unit person, but you actually have to have both. Just having your walls in and contents coverage will not rebuild your structure if it's sucked into the river. You'll get your check for your contents and any, improvements or betterments you did on the inside. Say we'll call that 50,000, but you won't get anything for the walls out to rebuild your structure unless you actually had a condo association policy. After some of these, we've had 5 big events in just the last 3 years in New England. Not going to just say Vermont because Maine, New Hampshire, parts of Mass have all been hit too. In that time, what I'm seeing in my work day to day, so many people thought, well, my association had a policy, and they did, a homeowners or a condo association GL policy that maybe had a $25,000 flood toss in, but $25,000 did not rebuild some of the structures that were gone. So a lot of people have taken a smarter or better or deeper look into what are the bylaws for us at this association. If your association bylaws don't require your association to get a flood policy, but they require you, the unit, you're putting yourself at risk. And as a member of said association, however you've elected or however you've kind of grouped up how you govern that, you're basically putting yourself at risk. You need to have both. One will not cut it. It just won't.
So you should advise your client to advocate for,
For sure,
to check to see what that association, if, coverage.
you want to look. So if you're a unit owner,
Yeah.
double check to make sure you've got that other part of the policy, which actually covers the structure that holds you in, basically. One of the big things that kind of came out of the flooding that happened in last summer is that, I don't know, we call them property or portfolio managers, where they may manage a bunch of properties. Sometimes they didn't tell their tenants that their building was in a flood zone. So sure, building structure guy, he's renting to these people. He had his flood policy thinking he could cover their stuff on his, but that's not how it works. If you don't own it, you don't get coverage that way. So the owner needed coverage, and then each one of his tenants did, but they didn't all know. So now it kind of broached the discussion of, do they all know? So when you think of a condo association, that could be 1 building, it could be 20 buildings. What if only 2 of them are in a flood zone? If 2 are, you all are, but for pricing and point, I can understand where an association would say, well, these 2 have to get their own, but these ones don't. But again, as I said with my own story here, you all do, because if 2 of you are, the water's already coming that way and we know it. So everyone's really at risk. So it's important that you're pushing it to association, you cover our walls out. Unit owner, you're covering your walls in, and you have to have both to have actual coverage for yourself, because you can't have one without the other. Or you can rebuild the building with your association policy, but if you don't have a unit policy, you can't fill it again. You don't have stuff anymore. No one's going to replace that. Or your business income, whatever it is. And same for the opposite. If your walls in, so let's use that structure right there. You had a walls in policy for the 3rd floor. Here's your check for $40,000 for your contents. Well, what do? I can't rebuild this with that. That's correct, because you weren't covering the walls out. You were just covering your stuff on the inside. Neither one of those are a good conversation to have. Neither one. All right, so here's my questions to you guys. Of course, I'm sure you've been asked many other questions already. I don't pretend to understand how the Zoomy questions that Sue asked go, but these are some things for you to think about when you walk out of here or you leave this class. I know everyone doesn't love flood. Some do, like me, but there's some things you have to think about. You can't say to someone anymore, Well, the NFIP is your best bet, unless you know that to be the case. And you only know that to be the case if you actually ask your customer the right kinds of questions. So the discussion part is, what zones were these examples in? 2 of these were in an X zone, many year long-term life there in an X zone, and one of them was in an AE. Now, those aren't the high zones, right? But it can rain anywhere, wherever you live. So these 2 examples were obviously one personal to myself, but these are in communities that I see. Like I drive by these buildings, obviously I live at one, but I drive by or have been near all these places. And if I could have discussed all their neighbors as well, I totally would have, but we didn't get kind of permission for that. But this is just one blot on the map that a lot of people were impacted in. And only some were in X, some were in A, you know, but you don't know. So these zones kind of, I want you to think about it. When someone says I'm in an X zone and my lender doesn't require it, that doesn't remove your risk. And the water doesn't care that your lender didn't require it. It will still come to visit you if that's the place that water's going to go. Having coverage when it's not required doesn't mean it's expensive or a waste. It's called cover your butt coverage. I don't know if I can say that on a video, but it's cover your butt coverage. I can tell you, I would rather have a check for $250,000 right now to repair my home than oh, I wish I should have. You know, the woulda, coulda, should have. And then the other part of this is, in these examples, there was mitigation, there was insurance, and then there was kind of a combination of both. So we saw that Union Mutual kind of took on their method of mitigation. For us, insurance, mitigation, I'll try anything at this point. And then a combination of both, really. So what do we need? Is 1 enough? Is 2 enough? Do we need to take on different ways to do this? Self-insurance, combining other insurance. Do we need some of that? Those are questions you have to ask. If your house is only worth $250 and you only have 100K in contents, really in today's value, and you don't have a basement, that NFIP policy, so long as it's deemed a flood, is going to come help you out. But if some of those answers are, my house is worth 500,000, or my contents are worth 200,000, or my basement is fully finished, that policy is not going to answer for you at the time of a claim. And you need a policy that addresses that finished basement or those higher limits, whether that means you get one NFIP policy in an excess, or you get a private policy that does it all in one, but gives you those extra like basement coverage and expanded value coverages. There's options out there, but you have to know what they need before you can say, this is my only choice, because there's many choices now. And then the last part is, oh, go ahead.
I think I missed a question that somebody asked if are there risks that neither NFIP or private flood market will cover.
There's always going to be some. I think I used earlier on like a lighthouse that's on little rocks. Like there could definitely be a house that no one wants to write. If your house is right in the river and the river comes up to you, I can say that the private market is going to be like, that's a really, really difficult, severe risk. I know my policy is going to pay out to you, and repeatedly it's going to have to do so. So some will say no, others will say I'll do it for a price, right? And they're gonna pick a compensatory type amount or a go away price. Sometimes I call it. They're like, here, we'll do it for 100K, and it's like, yeah, I'm not doing that. But so the answer is yes, that there are places that NFIP won't write and private won't write, but for the most part, someone scoops up one or the other. So NFIP doesn't do Cobra, private will do that. NFIP won't do, I think it's Peninsula. So if you're already on an island and there's no one else with you, so if you're in an island and you have no neighbors and you're surrounded by water, NFIP won't do that because their policy could never pay, you're already flooded. And private, depending on their definition, might be able to write you on that island because they may not require that it's 2 people. It's just that you are impacted. So it depends. So yes, you're right. Some may not, but it's rare to see that. It's rare, but I can think of a few.
And the market's changing
every day.
It's really the competition you're seeing really, and new ways of approaching. You know, we recently started talking with a carrier that's offering a parametric solution, which is kind of interesting. I'll probably see more of this in the future. Do you want to just give a good idea?
Yeah. So There's some new programs out there that feel like they have enough data and mapping ability to basically say, if I install a sensor at your house at this level, I can offer you a policy that will kick in as soon as it hits. But what it's doing is taking data from around you, specific data at your location, and using technology to kind of preempt a flood coming and when it's happening, and being able to take that data out, but get you covered in a different way. It's a totally different kind of policy. It doesn't have exclusions or coverages or whatever. It says, if this target is hit, or this just trigger point, which is you pick it by the foot at your home or commercial building, you pick it by the foot. If this is triggered, here's your check. That's it. So I can't say I've written a bunch. I've just started to explore and kind of read their forms. So there's plenty to look at there, but reading the forms is really the overarching statement there. There are so many new things on the horizon, so many new programs, tech people, tech startups, and combining insurance tech startups that are looking for new and better ways to kind of give us coverages and stuff that we need, the best possible price. Sometimes that means cutting out a human, right? Just, oh, rate it yourself. Here's what you got, go. Okay. We all know though, insurance wise, like part of it is human. We have to talk to each other or the insurance, of course, but like so much is new. Flood isn't over. As much as I've learned so far in teaching you some of these basic things right now, there is so much more. It's forever expanding, and there's no cap on it. Catastrophic events are going to continue to happen. They're going to be more frequent. They are going to cause more chaos. And the only way society can continue like on as we are and have been is to kind of try to get in front of it as much as we can, but not be left behind. So these prometric type things where they have sensors and data, that's a new wave of future. No one would have thought of that in the 70s or even the 80s or 90s probably. But 2020, here we go. They're coming out, they're out there. They have to kind of prove themselves a little first before I think we all put some trust and faith. But I have a strong idea that in the next 10 years, more people are going to have that than NFIP policies. It's a lot easier. Any other questions out there before I go
Yes,
on to
a couple more. Do you think regulators are going to place further controls on things like condo associations to prevent those no coverage situations?
So I feel like they're always going to push that back down. So every condo association is built by itself. You decide your own bylaws. Like no one's going to want to, the government's not going to jump in there and change that for you, but the government might change how our NFIP unit owner policies are done. So sure, I'll give you a unit policy, but only if you prove that you have an association policy. So there's nothing out there in the land literature, and I bet I'm going to ask that at the flood conference, but I feel like it's something that they're going to have to address, and that might be the way to do it. So right now I have one carrier that does that. If they give you a unit policy, they want confirmation that you actually have an association policy, and they give a pretty big write-up that says our policy covers this and this specifically, so you need to have this, so you got the rest of it. So don't know if that works out, but we'll see if that makes sense. Any other good one in there?
Another question, how is Vermont doing now 1 year later on their flood insurance and rebuilding?
Oh, goodness. So there are some places that have finally made it. There are some that are still struggling, fighting, or didn't rebuild. There are restaurants and communities that haven't finished and finalized. My house personally is finally like, I haven't fully finished it again, but it's all operational and we were able to go home after, I think, 4 weeks. But it's still going, right? It's not over. Our rivers are still inundated with debris and disgusting, horrible things that ended up in the river from these kinds of things. So toys, car tires, parts of cars, trucks, pieces. There's a lot to go. Anyone that knows Vermont knows how much we really love our greenscape and our landscape, and we take our waterways very seriously. Like we have some of the highest fines for that kind of behavior. But in this situation, it's just now on us as a state and anyone else who comes in to try to clean it up. I know our Green Up Day, which is typically the first Saturday in May, we did like triple the collection of debris than we have done in the last few years. But I mean, Vermont is relatively clean, not that we don't have, you know, some trash out there, but this year you can definitely see people picking up a lot of that flood stuff that's still in rivers or trapped over here in somebody's like yard now. It was a river for that day or two or week, but now it's their lawn again. Even on my way here from Williamstown up to the office, it was farmland, so I believe they grew corn at one time, but the way the river came, it kind of cut the whole thing right through the middle. I saw a kid pool in there. I saw somebody sink. So I think we're on our way to healing. We are Vermont strong. You probably have seen the license plates. It's been going on for a long time, but like, we won't settle for it to not be the nice state that we've grown to love. We won't. There will be more strict things. I'm sure they'll put out more programs of, can you clean it up? We've got to. I know a lot of communities are Barry, Williamstown, Montpelier, of course, Rutland, Bennington, obviously. They're taking a real look at how the rivers and waterways that we've kind of lost a little faith in kind of were built and structured, and how we can better improve them or like firm them up. In Williamstown, it took about 6 months, but they did fix that waterway in town. And that seemed to help quite a bit. But that water still came up again, I think, just before Christmas this past year. And it came up hard and fast because it just didn't stop raining. So we're getting there. We're getting there.
One thing I also just want to just toot the horn of Vermont Department of Financial Regulation. You know, that in Vermont, they're super engaged in the most difficult challenges we have in insurance. They're not just, you know, overseeing, you know, your licensing here. They're involved. And earlier we talked about, you know, what's the size of the private marketplace versus NFIP, and Diana mentioned that we have less visibility into you know, what the private market is doing. We also don't have as much visibility about the losses experienced by people without insurance at all. And the state is undergoing an effort to aggregate that data, collect, you know, from people to try to really understand what the real impact of this flooding was in Vermont, so that we can figure out what the best way to address it in the future. Mitigation, insurance, combination of both. We really need to understand the problem and understand the impacts first. So
some say stop the rain, build taller mountains, but the taller the mountains, the more water funnels, and we can't stop the rain. It's a continuous cycle. But last big point for people, I hope that you can take from here: who's most in need of flood insurance? And if everyone didn't just say everyone, then I should start the class over. If it rains at your house, it can flood at your house. Should it? Is it once in a million, once in 100, once in 10 days, once in a year? No one really knows that, and it's really just a guess. And I can throw all the data and all the land from every source at any time to you, and I'm still going to be wrong. No different than the weatherman or the weatherwoman who's taking what we know and what we have and hoping we're right. So everyone that has stuff that's important to them, home, building, personal contents, all of that. If you want to make sure that it is secure, you need insurance. And that's really the only thing you can do to save it, unless you're willing to pay it yourself. Now, I don't care if that means NFIP policy. I don't care if it's a private. I don't care if it's some NFIP, some private. That's not the point for me being here today and talking about this. It's that you have no coverage if you have no coverage, right? And to say it can never happen to me, those are the people that often say, I wish I had, because it'll never happen to me. Almost always turns into, I can't believe it happened to me, like, period.
And we're seeing, as we have a more competitive market landscape in the private sector, you know, you're going to be priced according to what that risk is. So, you know, you might be in that area where that technically is a low likelihood of there being a loss, and your flood insurance policy might be very affordable in that situation, and it's super valuable in the event of.
For $500, I'll take that check for $250 if I need it, or $250K. I think that's what I mean. If your policy is a couple $100, worth it. And if money is the only driver, then that's not how it really works. Catastrophic coverage, well, the pricing is important, and I can fully understand and relate. Working out money for a flood policy is not easy to do when you're a single family. It's not easy to do for a small business. Maybe it is for some bigger ones, but price can't be the first thing on your brain, and it can't be the last, because the price tag comes either way. You either pay for the insurance and get the coverage, or you don't, and you have to pay the price tag for everything that happened after the fact, especially after a loss. Any other ones in there?
I just, thank you very much for the presentation. I had one last comment we had was NFIP deductibles or options are limited. Keep in mind, private market allows larger deductibles for reasonable cost savings. And a couple of comments about thanks so much. Everyone needs insurance. This is a great class. I haven't taken a class in years and because I had to, and I really liked it. And
Well, thanks for listening,
So-
everybody. You got questions or if I can help in any way, I love talking flood, not just in this scenario. I talk it on the phone all day. I'm pretty sure my details will be in here somewhere and there'll be some kind of a follow-up, but reach out. You got a weird one, you got something
Yes.
that's like, how do I deal with this? I'm your lady. I want to know about the weird ones because that just prepares me more for just the world that we live in. I see a lot of weird already, but if you have a weird one and you need some support, I'm happy to help out in any way I can.
This will be available on the website and on the YouTube channel, the Mutual Service Office. And we appreciate everybody's participation and thank you both for being here. And I'll see you in person in Arizona in 2 weeks from tomorrow. And Jan,
do it
do you
again.
have any comments you want to make?
I'm Jan Seitz from MSO, and I want to personally thank Diane and Evan. This was fabulous. Always thank Sue and all the people who did all the work to get us to this point, and a phenomenal turnout, and CE for those who wanted it. But excellent. I'm scared to death about water now, but but it was an excellent program and really
Your
well
body's
written.
water too, so it's okay. You have to take it with you. It's just a thing we've got to navigate.
But thank you very much. It was just fabulous. So, Sue, you got any closing comments?
Yeah, just remind you that our upcoming schedule next month, Nils Deacon will do a presentation on houses of worship. We may or may not have CE for that if I can get it filed. And Omnia's September presentation will be on soft skills. In October, Mike Farley from Ohio Insurance Institute will provide an overview of current legal trends, and we'll finish out the year with Mary Beagle from MSO about the trends in the BOP and the history of the BOP. As we mentioned before, the Ed seminar is November 12th and 13th. It'll be virtual. The topics are agritourism from Rich Palkowski of MSO, claims trends from a legal perspective, and insuring home businesses. And artificial intelligence is the fourth one. Contact us with suggestions for any future topics and presenters. Most of you know I've written over 200 articles, so I can always use ideas for new topics. Information on all programs is available on our website, msonet.com. As we said before, we're busy expanding our CE states. We're now in 31. We'll hope to be in 50 by the end of the year. And once again, we want to thank all of our sponsors and thank you, Diana and Evan, for everyone who attended. And thank you, of course, to our team who put this all together and do all the hard work of creating the certificates and doing all the back office stuff. So that's all I've got.
Well, thank you, everybody.
Thank you so much. It's
Thank
been
you.
really